Hey guys, it's our part 3 of monetary policy chapter, and now in this lesson we're going to talk about the monetary policy and its types is. So here, first of all, let's begin with the monetary policy. Monetary policy is one of the most important macroeconomics policy formulated by monetary authorities known as in terms of Nepal Central Bank, which is Nepal Rashtra Bank. It is done to achieve predetermined economic objectives, you know, by controlling interest rate, money supply, changes in money supply, and obviously credit in the economy. So here the thing is that we got to understand about is interest rate, money supply, how because of interest rate money supply increases or decreases, and about the economic stability, about the inflation. We got to in Australia understand about the credit, it means loans, and how it affects, so yeah, let's get into the topic. So the thing is, monetary policy is one of the important monetary policy of macroeconomics formulated by the monetary authority known as Nepal Rashtra Bank. They are the ones who control it, and they look when economic growth is high and when economic growth is low, when inflation is high. And there is only two terms here in monetary policy, that is its types is which is expansionary and contractionary monetary policy. So let's see when and how they use this monetary policy. So when you heard about the types of monetary policy, then first thing you gotta know is when the central bank is gonna use this. So there are only two ways that central bank is gonna use it: when the prices will be really high of the goods, and when the economic growth is there, when there will be no like there will be unemployment all over across the country, there will be business in losses, and when economic growth is low. So in it's comes under the expansionary, and in our contractionary, like there are a lot of, like when the price of goods and services it gets higher, then there will be a lot of inflation, so they will obviously increase the interest rate, just to decrease the money supply, because people, if money increases, then there will be a lot of trouble for our common citizens. So if we wanna talk about this topic, first of all we gotta get through the expansionary, and if I have the most of the understanding, so let's go for it. Expansionary monetary policy is used when economic growth is low and the economy is slow. Okay, so what does the central bank does here? So let me get into the topic. The central bank does here is what? So when our interest rate, they decrease the interest rate when economic growth is low, less, its economy is slow, they decrease the interest rate. And when interest rate is decreases from suppose 12 to 8%, there will be you know loans, loans become more cheaper. And when loans become more cheaper, people take more loans. When people take more loans, there will be more money supply by spending in investment, business, and in their daily lives. So it will increase the money, it will increase the economic growth. And suppose that again there is unemployment, business are slowing down, economic growth is less. Suppose the interest rate decreases from 12 to 8% once again, then there will be more loans means more investment means more production means more jobs means economic rises. So this is how it is done. In simple word, we could say that when the economic growth is low, when the so this is the economic growth. Okay, when the economic growth is low, and when the inflation, then they decrease the inflation rate. And when the inflation rate is low, there will be more loans, there will be more loans. And when there will be more loans, there will be more money supply. When there will be more money supply, and there will be increase and rise in economic growth. Alright, here we are done with this. So now let's get down to the business of our last topic of today, which is contractionary monetary policy, and it is used to when inflation rate is high, when prices are rapidly increasing, and it is done by Nepal Rashtra Bank. It is obviously managed by Nepal Rashtra Bank. As I told you earlier, when economic growth is low, that's the one condition, and when the inflation rate is high, that's the second condition, So what the central bank does here, when the inflation rate is high, prices are increasing, they increase the interest rate. When interest rate also increases, the loans decreases, people do not take that much more loans, and when loans decreases, money supply decreases, and when money supply decreases, then obviously prices comes to stability. So what does central bank does here? Let's go down briefly. So interest rate, suppose interest rate is high or not, suppose inflation, okay, first level, inflation is high, interest rate is high, the NRB, Nepal Rashtra Bank, increases the interest rate because people are taking more loans, and when people take more loans, there will be like rise in price. So to decrease that, central bank, what do? They increase, they charge more money from people who take loans. So obviously people are not that fool that they will take more amount of money for their own source, for their own desire. So like it means in simple word, if the inflation rate is high, the interest rate is high, and when the interest rate is high, there will be less loans, people will take less loans means less money supply means less what do we call, less inflation, like there will be fall in inflation. When fall in inflation, there will be price stability. And yep guys, that's it for today, and this is the only topic I had for now. And in our furthermore classes, we are gonna talk about its objectives, its instruments, and the features, everything guys. So till then, take care, bye bye, hope you are having a great day, see ya.